All right, Nathan, thanks so much for joining me today. I'm really excited to give our investors the next part in our webinar series of Passive Profits Blueprint, and appreciate you coming on board.
Yeah, thanks, Judah. Happy to be here.
It's going to be exciting to give them all a chance to really get a better understanding of what you and I do on almost a daily basis, right? Underwrite our properties in order to really understand what opportunities are out there and what the risks are, how it helps us really try to achieve the track record that Vikings have been able to achieve, and how we're going to look about finding more opportunities going forward. By way of quick introduction, I've been with Viking for 3.5 years now, came from the legal side of things. Originally, I was practicing non-real estate law, eventually came to the real estate side of law. As soon as I was talking shop with my clients, I knew I wanted to be on the investment side of the world. Spent a couple of years on the investment sales side, capital markets advisory, really cutting my teeth and really spending hours and hours and days and months and years underwriting properties for other people, whether that was sellers or buyers, borrowers or investors, before coming to Viking Capital about 3.5 years ago and doing the same thing for Viking and Vikings investors. And it's been 3.5 years of really a great ride in the market, really taking advantage of some great opportunities and, constantly improving those skills, on a monthly basis.
Absolutely. Appreciate it, Judah. I am Nathan. I kind of serve multiple functions within Viking, one of them being the senior analyst, so working closely with Judah underwriting properties, and then also the director of strategic planning, meaning that I set up systems operationally throughout multiple departments within Viking. I used to do commercial real estate, brokering office space, then moved into some fix and flips on the residential side of things and kind of combined both of those, the scalability of commercial with kind of the helping people aspect of residential, and moved full-time into multifamily. For a while, I was doing on-site property management for a large REIT, but similar to Judah, my heart, passion, skill set was always more on kind of the ownership, investment, and asset management side of things. So joined Viking a little 2 years ago, and now ready to kind of rock and roll into the underwriting, because what Judah and I do on a daily basis.
Yeah, and it's interesting that you say that, Nathan, because you and I are so often in the weeds, right? In the grind of, looking at well over 1,000 properties a year. We're so into the details. This was kind of nice actually to prepare for today's, mini webinar, to really take a step back and remind ourselves, well, what is underwriting? Why are we doing this? And more importantly, why is it important to our investors? How can they benefit from this themselves? Whether they want to continue investing passively, whether they want to start investing actively, or whether they want to continue investing with Viking, right? But on a more educated and sophisticated understanding.
Yep, absolutely. The whole point of underwriting is really an assessment of the risk and returns of a potential investment. It really kind of sets the foundation, the backbone almost, if you will, for the business plan of how to run that property and ultimately, hit the projected returns that we pro forma, not only in terms of ultimate kind of investor level returns, but also property health. What's the projected revenue, the projected expenses, the debt service, and how can we, best position ourselves at Viking to really outperform on all those fronts?
Ultimately, when you're investing in any asset class, in any type of product, right, we can get into as much detail as you want to. Ultimately, it comes down to buy low, sell high, right? We can get off the webinar right now, and if everyone can just have a good understanding of that, you're already starting to take steps towards understanding what underwriting is. Now, what we do though is we say, okay, how do we know we're buying low? Prices move, right? How do we know we're buying at a price where there's opportunity? And how do we understand that we'll be able to sell high, right? One simple way is to bet on the housing market, right? Over the last 12, 13 years, you didn't have to be a very good operator in order to do well. And some people did okay because their timing was great. But the firms that we've worked with, Viking especially, has achieved outsized returns because we weren't betting on the housing market. We go in and we create value. So underwriting is looking at a property and saying what potential is there? How can we increase the revenue so that when we sell it in 3 to 5 years, we're selling higher than we bought it? In some ways, you can buy high and sell higher, right? As long as you know that opportunity and runway is there. The flip side, as you mentioned, Nathan, is really the risk side of things. What risks exist? We can definitely jump into right now. A good place to really start would be to run through, even just in multifamily real estate, there are multiple strategies you can go about investing in. Core, value add, ground up. Nathan, you want to start hitting on a couple of those?
Yeah, sure. So core is what you think of kind of class A, almost new development, where it's stabilized, it's in a great, area of town, and that produces, steady, albeit lower returns than some of the other methodologies that you could use. One that we really like to tune into is value add. That's where you're going in, you're doing renovations on the interiors, you are doing a facelift, enhancing the curb appeal on the exteriors, or it could even be a kind of a core plus play where it's a newer vintage property, but there's some sort of opportunistic component, whether that's optimizing your expenses or reducing the amount of vacancy and concessions that are on the property. And And then you kind of move into ground up. That's kind of the what you think of as basic new construction, where you don't have as much cash flow, especially on those earlier years, but there is tremendous upside when you do go to sell the property. So it's all about aligning your goals with the asset type and the property type that you're actually investing in.
And each one of those types of multifamily investments carry their own risk profile. And it's really no one of them is the right or wrong investment. It's all a matter of selecting what your risk reward profile is and where you want to be. So the core strategy, Nathan, you mentioned, like you said, that's midtown, downtown property. It's already been built. It's fully leased up. You're already getting top rents. And that's where everybody ideally wants to live. Now, maybe not everyone can afford to live there, but that's where the jobs are. That's where the retail is. That's where the entertainment is, the main business district. And that's where renters will always most likely want to stay. So in terms of how much advertising you need to do, probably a little less. Everyone's looking to live there. Your kind of worst case scenario is that you own a fully occupied property in a most desirable part of town. Not so risky. On the flip side, you can't really do much. Rents are already as high as they're going to be. They may go up over time, but you can't really push them more than the market will allow. And it's a new property. It's got the best amenities. It's already got the wealthiest clients. There's not much you can do to make it better. Low risk, low reward. And to some people, often certain family offices, endowment funds, places that have a lot of capital in place, don't have much of an appetite for any risk at all, that's what they're looking to buy. Value add that you mentioned, where Viking often plays, before I get there, let me actually jump to ground up. Ground up is the highest risk and highest reward. You're buying a piece of dirt sometimes, nothing more than dirt. Sometimes it's not even zoned for multifamily. You got to get it rezoned. You got to get the permits done. You got to get any sort of variances you need, get the community nearby on board so you can build your new building. There's a lot of steps that have to go through before you have a building, let alone leasing it up and all of that. Now, because you're buying dirt, and you're putting in the soft cost, you have the highest reward. You're turning from nothing into something. Your downside risk, though, is that if you don't get zoned, you don't get the property built, your borrowing costs change, your cost of building change, you could be stuck with a pile of dirt, producing no cash and worth little more than you bought for it, maybe even less if someone now knows you can't even build a multifamily property onto it. Where we love to operate is the value add space. Those are properties that are not new, anywhere from 10 to 40, 50, or even older than that, where they're in need of some 10 to 11 care, some TLC. You have to go in and maybe the property next door is newer. The property next door maybe is just as old, but it's been renovated recently and they're getting higher rents. Now you know that if you go into this property and it's already fully occupied, it's already fully leased, you can start taking those units and as fast or slow as you want to, renovating them, adding pool furniture, converting the old tennis court to a new pickleball court with a gorgeous dog park next to it, bringing the amenities up as well for higher rents. Now you're taking a property and you're increasing the value. And your downside risk is that you're stuck with an older property that's fully occupied and fully stabilized. So your risk is much lower. Your upside is still higher. And those are the kind of property areas that you see in multifamily. Now, granted, you also have senior housing and student housing. There's, you have hospitality, which some might call multifamily. There are many other areas, but when it comes down to it, those are the main areas. That's what we play in. And Viking likes to be in that value add space. And now the goal is to really try and find a property where the risk reward is appropriate and where we can find a property where we can execute that business plan. Now, in terms of the next step comes now, a property comes your way, and you have to now what's called underwrite, risk manage, and see what the opportunity is. Now, the first thing to do, and Nathan, I know when in our pipeline, you're often the first line of defense. You're the first eyeballs on an investment opportunity. The first thing we do is look at where the property is. Talk about it a little bit. You're early on underwriting. When you kind of look at an area, you look at a city, you look at a street, what are you looking at to see, hey, is this something we should be investing in?
Yeah, absolutely. First, I like to start off from a state level, kind of high level. What's the inbound migration? Who's moving to the area? What kind of job growth is there? What kind of employment diversity is there? And then once we've kind of, honed in on states like, right now, Viking is targeting Georgia, Texas, Florida, the Carolinas, Arizona. Then you want to kind of dive in down into the major MSAs, because that's typically where most of the growth happens. And then it expands out into the kind of secondary and tertiary parts of that state. So once you find an MSA, you want to look specifically at median household income. So where are kind of the most affluent pockets? Where is the path of progress? So in what direction is the growth happening via retail, major employment centers that are coming to the space? And then also, what demographic are you serving? Is this a type of, tenant profile that is going to command, luxury renovations with granite countertops and stainless steel appliances? Or is this more of a demographic that would be satisfied with a light renovation where it's, you might be redoing the laminate countertops and just redoing the basic appliance package? So from there, once you get a sense of the overall, inflow of population, you get a sense of the type of demographics that you're serving, then it really gets down to almost the submarket level, where you're looking at the retail that's adjacent to your subject property. You're looking at the renovations of the comps in the area. You're looking at rents and seeing, all right, if we have a subject property, how can we raise the renovations or raise the experience for that tenant to really match the level that's in the market currently?
And listen, there are many ways to go about that, right? There are very complex ways. I know a real estate investment group around here. They do multifamily, they do core, they do value add, they do retail, but they look at cell phone data, right? They have a company that has they use cell phone data. You can literally see where cell phones are moving, right? So you can see literally where people are going. So if there's a multifamily property on a street, are people passing by this street? Are people going from this property downtown to work, or they work at nearby office hubs? That's complex stuff. It's going to be hard for our investors to relate to. But on the flip side, you can go on Google Maps and see, hey, what's the retail nearby? Are these companies I recognize? Is it a Starbucks, a Trader Joe's, a Whole Foods? Or is it a lower class supermarket that you heard of, or a no-name supermarket? Is nearby a liquor store, a gun store, and a pawn shop? Or do we have, nearby a nice daycare center, pet grooming, and, artisanal cheese? I don't know. But the point is that you can really get a sense of the neighborhood and what's going on without super highly complex tools at your disposal.
And at a relatively low cost too, right? Thankfully for the internet now, you can, drive Google Streets, you can get demographic information without even actually having to travel to that specific state necessarily. It's always a good idea to get on site and see those dynamics. But when you're doing your kind of initial view, you want to make it as quick but as accurate as possible.
Yeah, and the next step is that once you're comfortable with the area, the street, the demographics, look at incomes and all that. The next step is looking at risk management, right? What is the risk? What do you want to talk about mitigating risk? A great next step, once you've gotten comfortable with the location, is really taking a look at what's going on site. How am I going to mitigate risk? How am I going to identify opportunity on the actual property? You could have neighboring properties in the same location, but one has a successful business plan and one's going to be run into the ground by the operator. So you got to really now actually look at what's the opportunity before you. One thing you're going to do, and the first thing you're going to do when you either off market or more likely from a broker, is you're going to get a set of documents in front of you that you have an opportunity to look through. You're going to get the rent roll. You're going to get a trailing 12-month financial statement, and possibly, an offering memorandum. Now, the offering memorandum is going to do is tell you, in the broker's opinion, the way you can best maximize your investment. Now, I'll read through that. A lot of these brokers have really well built out teams of analysts, as well as industry experts on their side. And granted, they may paint the rosiest picture on behalf of the seller, but they do often come with a lot of data information as well. And oftentimes, they will usually tout the highest and best use of the property, albeit maybe a little bit of an exaggerated form. So get comfortable, get knowledgeable with that. But really what I want to focus on is the first two documents, the rent roll and the trailing 12-month financial statement. You may go on apartments.com and see what they're marketing as rents. You may go on the property's website and see what the leasing opportunities are right now. But that's really all marketing. The rent roll tells you what is going on the ground on the property on the date of the rent roll. How many units are occupied? How many are vacant? Usually it'll tell you of the vacant ones, how many are vacant and already leased, or it'll tell you how many are vacant and still unrented. It'll also tell you how many are occupied, but there's been notice given that they're gonna vacate. You get a good snapshot of not just the rent roll as it is now, but the strength of the renewals and what's going on for the ones that have been already vacated, or the units that are given notice they're going to be vacated. So you get a good sense of how occupied is this property. Also, you have an idea not just what the rents are being offered, but what are the actual rents for the leases? How much money is being offered? You can look at the leases that were signed in the last 30, 60, 90 days, as opposed to the leases that were signed 10, 11, 12 months ago. Usually we're dealing with 1 year, 12-month leases. And you can see, have leases moved on site, right? What are the 1 bedrooms leasing at relative to the 2 bedrooms, relative to maybe 3 bedrooms? All that'll give you a lot of information that'll let you know what's going on now and what's been the momentum. What are the trends on the property as you get a good sense of the meat and bones of the property itself. How many people signed on leases, right? Maybe it's 1 name on the rent roll, maybe it's 2 names. A lot of information in the rent roll itself, which will give you a good sense as to the strength of the property. Then look at the rents nearby at other properties that are being marketed, and you'll get a sense of where does this sit? Is there opportunity? Are rents below market? Are rents here already kind of above market? And I should be afraid that they're going to maybe slide backwards to what properties nearby are renting for. So that's just a snapshot into what you can learn from the rent roll itself. Nathan, you want to speak to the trailing 12-month financial statement?
Yeah. So the trailing 12-month is essentially exactly as it sounds. It's the last 12 months worth of revenue and expenses on the property. And it's split up into different categories, right? At least for multifamily, you have admin expenses, you have leasing expenses, you have repairs and maintenance, you have management fees, you have utilities. So there's all different expense categories. And what you'll soon start to realize when you're taking, a look at these properties, that they all typically fall in call it 40 to 50% what we call an expense ratio. And that's the total number of expenses relative to the total number of, or total amount of revenue. And so when you notice that a property has higher expenses, it's going to be one of two things. It's either low on the revenue side or it's high on the expense side. And when it's high on the expense side, right, there's typical rules of thumb, or just based off of our operational expertise, we know generally what each of these categories operates for. You can start to recognize opportunity there. So if there is extremely high repairs and maintenance, for example, and you know that you're going to renovate the units, there's high likelihood you can probably reduce that R&M expense. And ultimately, that will drive the value of the property as well.
Yeah, it's important to understand this is an operating statement. So what it does is it breaks down from top to bottom what money's coming in on the property, what money should come in on the property, right? Because then you have negative line items for vacancy or people who haven't paid their rent and they owe the money. We call that bad debt. Or you have concessions. Maybe you're offering a discount. They're offering a discount on the unit. Maybe you have an employer's unit, right? Employee unit, where maybe the leasing person lives on site and gets a discount to their property. So it really breaks down what all the rent should add up to, what hasn't come in yet for whatever reason. And then you have lines of other income, meaning you might charge a pet fee, you might rent out some storage units, and that gives you your revenue. On the expense side, there really are some main broad categories that are what it takes to operate a multifamily property. You're running a small business, so you have administrative costs. You have to lease your apartments. You have leasing marketing costs. You have a staff on site, right? You have a leasing person, maybe a maintenance person. As you get really to smaller and smaller properties, you may have no one on site. You may share with a nearby property or have temp labor, or maybe all outsourced. If it's just repairing stuff and you don't have any staff, that's payroll. You then have repair and maintenance and contract services. Those are people when you're fixing the refrigerator, or you're getting the grass cut, or you have to patch the roof. And then you have the utilities, right? There's the water, gas, trash collection, all happening on a regular basis on the property. And finally, you have insurance, because you're insuring for any property damage or loss or any liability you might incur while owning the property. And you have taxes, your real estate taxes, right? Those are really the major expenses to running a property. And as you get a sense of what it takes to run a property, you'll notice that, hey, their payroll is really high. And in fact, maybe they're overstaffing a property. Maybe it's how the seller likes to operate. You might say, actually, I can spend less on payroll because I don't need that many leasing people on site. You may say they're actually really low and they're spending very little to fix the property. And when you tour the property, you notice it's falling apart. Now you know that when you take over the property, you're going to have to increase expenses. Remember, the goal is buy low, sell high. If you have to increase expenses, that means you're lowering your income. That's a red flag. So again, getting comfortable with all these line items and what's going on, that's really your step one when underwriting these properties. Now, our investors might be thinking to themselves, wait a second, you haven't even talked about paying your loan. Isn't that one of the biggest payments you're going to make? It is one of the biggest payments, but it's not an operating expense. Nathan, you want to go into briefly what the difference between an operating expense and a capital expense?
Yeah, absolutely. So an operating expense is any sort of expense that's involved in the typical day-to-day operations of the property. So that's exactly what, as Judah mentioned, it's the R&M, those repairs and maintenance, it's the leasing, it's the management of the physical asset itself. Now, those are considered operating expenses. There are other expenses that are considered non-operating expenses. So they're expenses that you're still going to incur as an owner, but they're not specifically related to the day-to-day operations of the property. One of those is, as Judah mentioned, CapEx or capital expenditures. those are typically large projects that are more of kind of a one-time during the hold period. So let's say you're redoing the pool or you're resealing the asphalt in the parking lot. Those are typical one-time expenses that, although they do, cost capital, they're not involved in the typical day-to-day operations. Another non-operating expense is the debt service. And so that is the payments that you make on whatever financing tool you use to purchase the property. And those are considered non-operating expenses because they're specific to that owner. Two different owners could have two different CapEx budgets for their projects, and they could have two very different financing tools. So the idea is that the property is valued on the NOI, the net operating income, because that's the actual operational income on the property. And it's not so much relying on what you spend on these big projects or the financing that you get for that specific deal.
Right. The market, in free market economics will determine the market clearing price for any asset, including a multifamily property. And different owners will be trying to bid for the same property, right? I may look at a property and say, hey, I can renovate these units and I can spend all this money to increase the rents. Nathan, you might look at the property and say, actually, I just want to park my cash here, take the cash flow. I don't want to invest any more money than I have to. I'm not going to even get a loan. I'm just going to buy it in cash because you just sold your, startup business that you started 2 years ago and, made a ton of money. Now you're buying a real estate property just for nice cash flow. We're both going to bid on the same property. It's going to be one price. But the one thing that we'll have in common is that we both have to have the revenue come in. We have to have the operating expenses there, get that net operating income. What we do below that, what we choose to invest to increase that net operating income or not, that's really a personal decision. But now that we've spoken about the T12, we've spoken about the rent roll, the next major thing you have to understand as to what's going to be your bottom line making money on the property is the loan. And that right now you might hear in the news. It's all over the place. Rates are increasing, debt service is increasing. Just to really briefly talk about that, you'll talk to your loan broker, a local bank, whoever you might get your loan from, and you'll get a sense from them, hey, if I buy this property, what should I expect my loan to be? How much leverage will I get? I mean, what percentage of the purchase price and maybe even the CapEx costs, those kind of renovation costs, will I get from the bank? What do I have to bring to the table myself? And on a monthly basis, you'll understand what rate you're getting, what you're going to have to pay on a monthly debt service. Taking that out from that T12 below the line, you'll now know, okay, I know what it'll cost to operate the property. I know what my rents are from the rent roll. I know what's going to cost me to pay for my loan every month. Now I understand what cash is coming in if I buy this on day one. I would say that's probably half the battle in underwriting a property. And for the sake of time, let's now move on to the flip side. Okay, I know what's operating on the ground right now. What's the potential to come in? What can I do? You're going to tour the property. You're going to call the broker. You're going to call the owner and say, I need to get on the ground. I need to see this property. What kind of work is needed? Do I need a new roof? Maybe I don't need a new roof now, but I will in 2, 3, 4, 7, 10 years. You may have eyeballs on that for yourself. You may need an expert to come with you, a contractor to help you kind of assess what those needs are. But that's kind of another set of expenses you're going to have to know early on is, okay, to buy this, I'll obviously have to pay for the property, but I should also expect I'm going to have to put some work into the property. And some of that's revenue generating, like when you renovate the interiors or you make the pool nicer to attract tenants. Some is not. Some is put on a new roof. And I've never seen a tenant walk into a property and say, I love the roof here. Can I please pay more rent, right? So some of it's roof revenue generating and some of it's not. And again, due diligence is when you really try and get into the nitty gritty on the property, get on site. Some of it's before you sign your contract to buy the property. Some of it you're not going to have access to, getting into every unit on the inside, getting into every utility closet. That's only once you sign the contract, but all that's a part of the due diligence. Now I think it's really worth talking about what we kind of take the most pride in, and that's kind of our execution of a value add strategy. It's what's your business plan, right? How are you going to maximize returns? How are you going to really move the needle so you can buy low and sell high? And the way Viking does that is through increasing revenue. And there are several ways. Nathan, why don't you kick it off? Why don't you talk about how the nuts and bolts, kind of the skeleton of an interior value add renovation business plan?
Yep. Absolutely. So the underwriting process is all about replacing your assumptions with actual data. Right? You start off with assumptions, but ultimately throughout the underwriting process, you want to eventually replace those assumptions with new data that you find that can that will affect the business plan. Because ultimately that underwriting is the backbone of your business plan. It's what your property management team is going to work off of. So once you do that due diligence portion, it's really important to figure out, all right, if we're just doing, let's say, interior renovations, what are the renovations actually going to cost? What scope are we taking these renovations to? Are we putting stainless steel and granite? Are we redoing the flooring? Is there any sort of replumbing that needs to be done? And then once you kind of have an idea of how much it's going to cost, then you can look at, okay, what are the other comps in the area and what scope are they? Are we bringing them to the same top tier renovation? Are we trying to match only a partial renovation? Because the whole variety of renovations that you could do, from almost a full gut to more of a light turn almost, where you're just replacing carpet and maybe sprucing up the countertops, for example. So there's kind of three ways that you're going to drive value. One of those is going to be, again, through the interior renovation. Second way to drive value is to find other income opportunities. So these are other income opportunities on the property that aren't necessarily related to the rent of that specific apartment unit. So it could be adding in carports. It could be adding in smart technology to the units. It could be enhancing what we call RUBS, which is a utility reimbursement. So finding ways to capture more of the utility expenses, for example. So you have your renovations, again, that's interior and exterior. So you can also do a facelift. You can repaint. You can, as Judah mentioned, you can redo the roofs. You can redo the staircases, the siding, et cetera, et cetera. You have the other income opportunities, which are ways to find other sources of revenue outside of the rent. And then you have a reduction of collection loss. So that's essentially recouping more of the income that was lost either to vacancies or concessions or what's considered bad debt. Bad debt is rental income that is seen as uncollectible. So when someone moves out and they're charged for damages and you try to collect all that money as much as possible, but if they're, long and gone, you have to unfortunately write off that rent. In some ways, there's ways to optimize the revenue is by capturing more, or at least not having as many holes in your revenue bucket, so to speak.
Yeah, definitely. The two main ways that we look at it is there are ways you can renovate the property, make it nicer, and therefore people will want to live there more. Supply demand, they're willing to pay more to live in your building. That's going to increase rents. The other way is by increasing what we call operational efficiencies, right? Kind of what you just mentioned, right? Collect more of the rent from the tenants that are there. Make sure that the tenants are paying as much of the utilities as they can. And sometimes it's providing services, right? Like, for instance, some communities, there's an appetite for valet trash. They don't want to have to carry their garbage to the dumpster. You get a service come in, and on daily, maybe even more than once daily, they'll come to the door, get the garbage, and bring it to the dumpsters for the tenants. Now, obviously, we pay for that service as an owner, but usually the tenants pay even more, and it generates revenue on the property. Maybe there's storage that they're providing for free to tenants or very, very low cost, and there's a huge waiting list. Well, that means you're not having supply and demand meet each other in the equilibrium point. You should really be charging more for those storage opportunities because tenants are willing to pay more. It's better for them to store it near their property than to go to some storage unit down the block. So all those are ways where you can increase revenue with really out costing the property any money. So those are really the two main avenues we look for. And when someone's looking at a property, they got to understand what's the potential. Kind of bring it home now. We've gone through, we've talked about debt already. I'm going to pause it here. What do we have left on the slides?
That's
I
it.
feel like we're good on time, right?
Yep.
Let's go back 1 second. Let's have Ashley pick it up from here. What I want to do now is really just summarize. So maybe I'll, in a second, just so we've kind of gone through all the main points of underwriting, and let's recap it. What do you think? Anything else you want to talk about? No, I'll talk about the support negotiation part. I'll say why it's important.
Yep. And then just
as a part of my summary.
And then investor confidence. Yeah, I'm fine with that. Just let me know. Are we doing the financing slide? Do you want me to go here quickly or not?
I think we spoke about it briefly before. I just think we have time for it.
Yeah.
It's a whole can of worms.
So let me talk about it briefly, just like one sentence, so I can go to this side, and then we'll end on this slide.
Okay. Why don't you pick up then?
Okay.
So go here. You'll pick it up, and then when you kick to the next slide, I'll talk about. I'll start summing it up by. It also it can support negotiation and boost confidence and all that, and then I'll start summarizing.
Okay. What did you leave off with? Do you remember?
No, I picked it up in a ramble.
Okay, got it.
Because you went to the financing thing, and I said, I don't know, just go for. I think to get ahead of pause.
Yeah, that's fine. Okay. All right. So in addition to the value add and the renovation and the upside there, I know we touched on this briefly, but there's also upside in choosing the right financing terms and the right loan for your property. It's almost like a key in a lock where you want to find the right financing tool to really finance the property at the right leverage, at the right interest rate, with the right amount of what we call interest only to really kind of boost cash flows, especially during your hold period. But then also thinking about when you go to sell the property, what is the right financing, tool when you go to sell? Because some debt and some loans have some serious prepayment penalties, meaning that you have to pay, a large portion of the interest or the loan balance when you go to sell the property. So when you think about your hold period, you also have to find the right financing tool. Judah and I, on one of our latest deals, sourced over 15 different financing tools to find the right one that best fit for the property.
Yeah. And all this work that we do, and then I hope our investors will begin to do also, doesn't just help you find the best deal to invest in. No question about that. But there are other side benefits to it also, right? Ultimately, most of this work you're going to be doing before you submit your letter of intent to buy a property, right? You have a negotiation with the seller. The more you know about the property and you know about the opportunity, the better you'll be able to negotiate the purchase of that property, right? They may try and strong arm you and say, what do you mean you have the opportunity to renovate all 300 units on this 300 unit property. And you might say, well, not really, because the previous owner before you actually renovated half of them. So I really can add a little bit to those units, but I only really have half the units, 150 where I can really add value. So it's really not worth as much, right? Every piece of information you have will be another arrow in your quiver when you're negotiating, the contract. Additionally, the more you know, the more confidence you will have, and the more confidence you'll be able to give to your investors when you're either raising the capital or going forward with the investment plan. So obviously it mitigates risks. It obviously finds and identifies the best opportunities, but also the more you know about the property, the more granular you get, the better it'll help you negotiate and just carry forward with your investment thesis.
Yep. Well summarized, Judah.
So listen, we got a great opportunity. We spent, the last, amount of time going over really the nuts and bolts of underwriting and identifying properties, right? We talked about finding an area, a state, a neighborhood, a street you want to invest in. We've talked about once you now have a property in that area, what you should expect kind of by way of documents to get, what's in those documents, how you can really use them to begin on a just cursory paper level, reviewing the opportunity. We then spoke about getting on the ground, right? Looking at the property itself, what kind of capital needs might it require? What kind of physical aspects might there be of concern? And what also opportunities are there by way of either physical renovations or operational efficiencies that you can use in order to raise the revenue, which raises the net operating income and increases the value of the property, right? Then you're buying low and then you're selling high. Then Nathan, you touched upon how we can finance the properties, right? How we can be able to buy them. What should we be looking for from the loan partners in order to make sure we can have the best debt on the property to execute the business plan. Through all of these, very cursory early understandings, it'll really help all our investors take a look at the properties, our opportunities, their own opportunities, and hopefully better understand what they want to invest in.
Yep, absolutely. Yeah, underwriting is all about, as you said, Judah, it's about that risk and return profile and that underwriting, that pro forma, those assumptions that operating group is putting into place. That sets the foundation, that sets the backbone for the next 5 years worth of business. And obviously there's going to be iterations and adjustments as there should be, right? One thing I love to say is that underwriting is never stagnant. It's always evolving and should always be evolving given the new information that you find during the due diligence, through talking to the property management team. So hopefully you as an investor, when you're taking a look at, whether it's a pro forma for Viking or a different investment that you're in, is to really understand, hey, where are the risks and returns and how does underwriting help mitigate those risks moving forward before you actually invest?
All right. Now that we've kind of taken a step back, I'm kind of invigorated to kind of jump back in.
Absolutely. Thanks, Judah. Really appreciate it.
Thanks. All right. Before I stop this now, I want to redo the intro really quickly. And I want to give what to expect. So I know we had the intros at one point. Now let's just do the before the intros.
Like this slide?
Yeah. Yeah. So right before we get to the intros, which was just kind of, I think it was I didn't welcome because I'm not welcoming, right? Excited to be here. I'll let you say a couple of things, and then I'm happy to really just jump quickly into what to expect. Ready?
Yep.
All right, Nathan, happy to get started here on the next part of Viking's webinar series, Passive Profits and Blueprints. Really excited to give our investors a good idea of what underwriting means and how we can help mitigate risk.
Yep. No, thanks, Jude. I really love being here, and I love underwriting. For me, I'm a numbers guy at heart, but I also love explaining kind of the nuances and the financial aspect of multifamily, because ultimately we can talk about multifamily investing as a whole, but it ultimately comes down to the underwriting and kind of the backbone of the business plan moving forward.
Yeah. Investors should expect to be able to, over the next about half an hour, hear us talk about what it means to underwrite a property, right? Identifying where you want to invest, then finding a property and kind of start to dive into the nuts and bolts of how you can review the financials, what you should expect when you see a rent roll, right? How you should look at the physical needs and how to identify the opportunity of how you can improve the property and add value, what to expect when you're looking for a loan, and ultimately how to package that all into a beneficial way to identify an opportunity and hopefully win a deal.